Okay, so for this video I want to show you and explain debit spreads, which is a stock option strategy for investors and those actually people that don't understand stock options. Some people don't even know they exist. They all assume, or most people assume, that you buy low and sell high. While that is the case, the stock options help investors in bear markets, just like we all are hearing the rumors that the bear market is coming, the recession is coming, stocks are lowering, and many people are losing money. In fact, people can actually still make money by using stock options, but also reducing the cost basis to get into stocks. And as you can see, Friday, Amazon at 12:12 p.m. was trading at 17.80. This is the on-demand feature, which allows you to backdate, do tests, and even virtual account to play with money or play with your account to test certain strategies. So for this instance, this is what it would cost to invest in Amazon with just one share. But if you want to leverage that and reduce your cost basis, you can go on to the options. There are two main columns, calls and puts. Puts are usually a bear assumption, meaning that the stock is anticipated to go down, while the calls are the anticipation that the stock will go up. But there's also certain strategies within the options that you can do the opposite. So if you sell a put, then you want the stock to go up. If you sell a call, you want the stock to go down. When buying a call, you want the stock to go up. And when you buy a put, you want the stock to go down, or you're believing that the stock is going down and it's going to treat it like insurance. But that's a whole nother lesson. You can view my YouTube channel. I go over those. For this case, I'm looking at big lots. As of Friday, it was in a downtrend, but I assume with technical indicators, my fundamental analysis, it's going to pop up. We also have an earnings call coming up. So instead of buying 100 shares at 2037, I would simply look at the calls and the puts. And with that being said, a debit spread and believing that the stock will go up, I'm looking at the call side. So I would buy, if I wanted 20, it would cost me $1.80. And for stock options, one stock option is 100 shares. For every 100 shares, you're messing with one stock option. So it would cost me $180 with a max profit at infinity. Meaning if the stock was to blow up, it would just run up and whatever this option is priced at. The only downside, or not really downside, but one of the negatives about stock options is that they do not last forever. There are expirations. So each one of these in parentheses is the number of days to expiration. So just remember that. So if I was to buy this, I would want the stock to blow up at least within a certain time frame, and especially before 36 days, or I lose the 180, depending on what the stock option is priced at. If it's at least if it's 20 or 20 above, there might be some profit to capture and sell back. If not, then I lose the entire 180. So for debit spreads, you would buy the 20 strike price and then sell depending on the spread or whatever you want to capture. The bid, which is the sell side, and ask is the buy, so I would hold control and drop down to the 22.5 strike price, and as you can see, it reduces to 95. So instead of costing me $1.80, it's now 95 cents. Times that by 100 is $95, and the max profit is limited now to only $1.55. So theory, I bought something and in return I went ahead and sold it back, which limits the max profit. And how we get this is if you was to add up 195 and 255, that gives you 250, which is the difference between 25 and 22.5. Remember, 100 shares is one stock option, so 100 times 25 is 2,500. Subtract 25 or 200 or 2,250. It would give you the 250, which these two add up to. So that's how the options, or that's how this is calculated with max profit and max loss, if that makes sense. If it doesn't, get a hold of me and I'll explain that more in detail. So the same thing for the put side. If you was to be bearish and think that stock would drop, you would buy and then sell right away, and those two add up to 250 because I traded the 20 and the 17.5. Back to the call side, for instance, if I wanted to do the 22.5 and sell the 25, it would cost me only $45, and my max loss is what I paid for it. Anytime we buy something, the most that you can lose is obviously what you paid for it. So that would give me a 205 max profit with a maximum loss at $45. To look to see what this actually looks like, you would go down to Analyze Trade, and as you can see, there's the max loss and the max profit, and in between are the strike prices depending on the dates, which you can change here all the way up to expiration. So as you can see, the curve changes, and at expiration it is the line itself. So for instance, if we were at September 11th 2019 and the stock was at $24.80, we would profit $112.15. Vice versa, if it was down, it would be anywhere, depending on the strike price, a negative or still some profit all the way down to where it sinks all the way to $17.40 and $17, which is the max loss at 45. So that's the graph. That's how you can actually analyze stocks. The power of the Thinkorswim platform has all of these tabs, but that's the power, analyzing what your stock options can do and what the dates where the prices would be. If, for instance, if the stock was to blow up real quick by September 11th and you wanted to go ahead and close that out, you could close both legs, meaning the short and the bot side of the option, and capture the 180. Vice versa, if it was on a loss, you could hurry up and close it out and only lose, for instance, $9.29 rather than the full $45. Or there's other strategies where you can close one leg, meaning you can either buy the option back, keep the short or the long, and play it out depending on the price movement of that stock, and it could profit even more or lose you even more. So just be cautious of that. That's in another video as well, and I also teach all that to my members and the Investors Club members. So I hope this helps. Debit spreads are used for investors who want to reduce the capital cost or the cost basis to get into the same stock that they're looking into, and they also limit the amount of profit. But remember, anytime you reduce max losses, you limit your profits. So just remember that. If there's anything that I can help you with, feel free to reach out, and that's it for this video.